Hello and assalamu alaikum everyone. Today we are starting off the fourth chapter of accounting of business finance, which is accounting fundamentals. In this chapter, we're going to talk about basically what are the accounting fundamentals. Published accounts is going to be our main concern. What are published accounts is not that much of importance, but we are still going to look at published accounts, the contents of published accounts. The most important published accounts that we're going to discuss in this chapter are your income statement and your statement of financial position. These two are the more important topics since it's in our CIE syllabus to discuss the contents of each of these statements as well as understand them, how they are used, because in possibles, as you can see, there are going to be a lot of questions based on these, and the information that is provided in both of these statements also allows us to perform something called ratio analysis. We have to calculate something called ratios. Using that, we can analyze the performance of the business. So that's why we're going to look much more into detail into both of these rather than the other contents. The other contents, we're just going to have a brief overview of what that is, and even though that's not much of a requirement, but we still need to know what the basic contents are. And if you're an account student, then this chapter will be a piece of cake for you, and if not, then most of it might not make sense. So that's why we'll go over each of these things bit by bit. So what we're going to do, we're going to talk about published accounts, income statement, statement of financial position, the contents of published account, ratio analysis, and finally we'll wrap up the chapter with the limitations of published accounts, where the most important limitation is the lack of qualitative factors, and also look at financial versus non-financial indicators of performance. So without further ado, let's begin. So what are published accounts? Published accounts are the financial statements that every limited company has to issue annually as required by the law. When I say limited company, what I mean is public limited companies, large, small, every size of public limited companies, and large private limited companies. Not all private limited companies have to do it. Some do, and they don't have to publish lots of accounts, just small details. But other companies, public limited companies, have to provide a lot of accounts because they have to provide information to shareholders. Private limited companies don't have to provide that much information because they are not listed on stock exchange. We have talked about that in our legal structure chapter. So why should companies publish their accounts? Why is it that they need to publish their accounts? Why do they have to compromise their inner affairs to other people? The accounts of a company are published to give greater publicity to the company and to enable the members, investors, and public at large to understand the profitability and financial positions of concern. So all the investors, members of the business, public at large, basically your stakeholders. One word for all of these are stakeholders. You need to provide information to your stakeholders so they can understand. They can look at the financial positions of concern. So shareholders will want to see how much profitable the business is, the investors and all, they want to see if the business is profitable enough for them, if it is worth investing in or not. Your other stakeholders like your employees will see how much profit is the business making, and if they are making a good profit, should they ask for increased wages and salaries, and if the business is somewhat making losses, should they start looking for a new job. So there are all sorts of uses for published accounts, which we are going to talk about later on in this chapter. So what are the contents of published accounts? We've already have a brief overview of that it contains income statement and statement of financial position. These are the more important topics. Income statement is formerly also known as the profit and loss account, okay, but now it's called income statement because income statement itself comprises of 3 accounts, which we are going to talk about later. Statement of financial position was previously called balance sheet, so we might also use that term more often, but generally now it's called statement of financial position. So if in possible they refer to the balance sheet, you know that they are referring to statement of financial position. Other than both of these, we have other stuff which is not as important, but still it is part of published accounts and required by law. That is your cash flow statement, chairman's statement or chairman's message, whatever it's called. Sometimes it's called chairman's statement, sometimes it's called chairman's message. Both of these are the same thing. Then we've got director's report, auditor's report, and notes to the accountants. Sometimes this director's report is also switched with executive's report, so both of these are somewhat of the same thing. You don't need to look at very much all of the topics, all of the contents. We just look at the brief main ones. The main ones are these, and the others we're just going to have a brief overview, and that's what we're going to do in today's lecture. Look at the first thing we were looking at is cash flow statement. What is cash flow statement? It is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. Now, previously we have seen the word cash flow before when we talk about the difference between cash and profit, or somewhere around we have talked about cash flow, and if you haven't, then we will talk about cash flow forecast in detail, as it is the next chapter after this, the final chapter, that is cash flow forecast. Now, there's a big difference between cash flow statement and cash flow forecast. Cash flow statement is the statement that summarizes the amount of cash and cash equivalent entering and leaving a company. That's the basic definition, of course, but the main difference is that it tells you what has happened in the past, whatever the transactions have happened, how the cash has entered the business previously and left the business. But that is your inflows, money coming into the business, and outflows, that are amount of cash going out of the business. So statement is what has previously happened, and forecast is about what might happen. Okay, you're trying to look into the future, what might happen, how you can take action if you know that okay, this much cash will leave the business at this particular month. How should we take action? Will we have enough cash in hand? Will you have enough inflows to pay our debts and purchase inventories, etc.? So that's cash flow forecast, which we're going to look at in much detail in the next chapter. Cash flow statement, however, we don't look at much detail. We just look at the basic information that is on this page only. That's only what we're going to talk about in cash flow statement. So over here I have a basic, one of the examples of cash flow statement. It shows you about cash flow from operations, cash flow from investing, cash flow from financing. Okay, it tells you about how cash has appeared into the business, where it has gone out of the business. Okay, these whatever is in the bracket is basically your negative cash, that tells you cash outflows has taken place, and final cash at the end of the year. So it measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. So it tells you how the company is making cash, how much cash is it making, how is it managing that cash, is it able to pay its debts, does it have enough cash to fund its operating expenses, etc., to invest in machineries and equipment and all. So it basically focuses on the liquidity position of the business, and hence it also reconciles cash of the business with profitability. What this means is that if we know what's the cash of the business, we can compare that to the profitability of the business and make certain deductions from it. What are that? This can lead to two situations. There are two situations that might happen, that managers it helps managers realize why a profitable business might be running out of cash. A business is profitable, it's making a lot of profits, but it's running out of cash. And the other opposite situation will be that it is a loss-making business, but it is cash rich. So what's that? So how can a profitable business be running out of cash? It may have too long credit periods given to customers. It may be investing in large investment in machinery, etc. So it is making profitability, but the cash is running out of the business at a much faster rate than how much it will come back. So let's say you invested a lot of money in month one, and the profit, you are making a profit, but that profit, the cash from that profit will come into the business after 6 months, 5 months. Okay, so that's that. And if a loss-making business could be cash rich, how can that be? They have recently taken out some loans, the trade receivables paid earlier than usual by customers, there are new capital injections by investors. So the business might be making a loss, but all of these factors will indicate that it's a cash rich business. It has a lot of cash in hand right now. So even if you have not understood that much, it's just a basic information that okay, a profitable business can be running out of cash and a loss-making business could be cash rich, and cash flow statement can help you understand that. But that's not of much importance in this chapter. However, we will look at both of these situations in the cash flow forecast chapter, where we will have a better discussion of these points. So moving on, we have talked about the cash flow statement. Let's look at another example over here. You have got cash flows from operating activities, then all of the cash that has come into the business, that are going out of the business. and then again cash going out of the business from capital expenditures, then cash coming into the business. Okay, there's negative, there's positive, positive minus negative, there's 2000, 2000 plus 90,000 is 92,000. Okay, so there's that. It's just a basic idea of what a cash flow statement looks like. You might not have seen it before, even if you have seen it, it's not that important. Okay, right now at this point it's not much important because we're just looking at a basic overview of the contents of published accounts. The basic importance will be cash flow forecast, which we're going to talk about in the next chapter. Now there are other contents as well. There's chairman's message. It's an eagle eye view about the overall performance of the business. Okay, it tells you about the overall performance of the business and provides information on major achievements and future prospects of the business. That's about the chairman's message. Then we have something called auditor's report, which is a report on the accuracy of the accounts of the accounts and validity of the account. If there are no problem with the accounts, the report is clean, and auditors will state that the accounts give a true and fair view of the business performance and current position. Hence, it will be classified as unqualified report. If, however, there are issues, perhaps auditors are dissatisfied because some facts are hidden, there's disapprobation for window dressing, etc., the report is then classified as qualified. So sorry, there were little spelling mistakes. I have corrected. It was disappropriation or window dressing, etc. So basically, the auditor's report checks the accuracy of the data of the accounts of the business published around. It checks if the data is qualified enough or not, if it is showing the correct data or not. They basically, all this information over here, they just add it, subtract it, and see if this final data is correct or not, or the business has made some window dressing, etc., or if some sales have taken place or not. Basically checks the authenticity of the data, and if it's all correct, then it's unqualified report. And if it's not correct, if there are some errors in it, then it is a qualified report, after which there are some legal actions taken. Then we have notes to the accountants, which provides details to aid in understanding the information provided, such as the individual fixed asset, the main long-term loans, or the depreciation methods used. So it is basically a breakdown of sales and purchases made. Now, as you have seen, we'll see in published accounts, they just provide financial data and the minimum data. Companies try to provide the minimum of what is required by the government. Okay, the government wants you to publish it, so they provide just the minimum information so that the competitors cannot use it. But for your investors, you need to provide your investors with sufficient information so that they can use the published accounts to decide if the business is worth investing into or not. So that's where these notes to the accountants come in hand, where they provide you certain information so that the investors can assess the information provided in the published accounts more efficiently. Okay, they tell you about the depreciation method that they use, the individual fixed asset, etc. All the information that is useful for the investors. And finally, we have director's report. These outlines the financial state of the company by providing a summary of the company's trading activities and future prospects. So they provide what have taken place, what the business has traded before, and what do they want to do afterwards in the future. So it also provides a recommendation for dividends for the reporting year. Okay, it tells you how much dividends do they want to give to their shareholders, and helps shareholders understand whether the company has the capacity to expand and grow. Okay, so it tells them if it is worth further investing, or they should just sell their shares and move on to some other company. Okay, and it also informs how well the company is complying with financial reputation and social responsibility requirements. Okay, it tells you if the business is complying with laws and all other stuff. Okay, it's just that you need to know this stuff that I have written down. Okay, these points, just memorize them just in case the examiner asks you, even though they have in the past they haven't asked you this, but you need to know this basic data, because we are going to talk about the limitations of published accounts in the end of the chapter. And having this data, you can understand, okay, what data is provided in the published accounts and what data is not provided, because of which it can be misleading to your investors or does not provide sufficient information to investors. What else should be there to help investors understand if it is better to invest in the business or not. So that's all for today. We've talked about the contents of published accounts, what are published accounts, and why do we need to publish them. In the next chapter, we'll talk about income statements and statement of financial position. Thanks for watching, and Allah Hafiz. See you soon.